afternoon. Thanks for joining us today. We have another presentation with Discovery Silver. This is going to be focused primarily on the recent PEA that they put out on Cordero. So if you're not that familiar with the story, I would encourage you to check out some of the previous webinars that you can find on the Adelaide Capital YouTube channel. With that out of the way, I'd like to introduce Taj Singh, CEO, Forbes Gemmell, VP Corp Dev. They will run through a presentation that's focused on the PEA, and then we'll do Q&A at the end. So if you have questions, feel free to input them in the Q&A box. And as always, this presentation will contain forward-looking statements. With that out of the way, over to you guys.
Perfect. Thank you, Deborah. Good to have everyone here. Yes, as Deborah mentioned, the primary purpose of today is to go over the financial and technical highlights of the PEA. Some of you may have seen some of these slides already in various presentations over the past week since we put out the PEA, but we thought it'd be good to go over it here and have obviously the investor Q&A as well. So moving on, just to give a little bit of context, we talked about the forward-looking statements. Just a quick bit of context on Discovery Silver and on Cordero. We are focused primarily on our Cordero Silver project, which will be the topic of today's discussion. Cordero is located in Chihuahua State on a major gold-silver belt, home to a lot of long-lived and robust operations. You can see in this map here, we are recently just released a PEA. And prior to that, about a month prior, we released a updated resource for the project, which showed over 1 billion ounces in all categories and over 90% of which was in the measured and indicated category. So that speaks to how de-risked and advanced this project is. It's had a lot of work done on it, both in terms of drilling as well as engineering. The local infrastructure is also excellent. We'll be talking about it, but it provides some very inherent advantages in terms of capex and opex, and we'll talk about it in terms of topography being fantastic, terrain for an open pit, power line very close to the property, major road close to the property. All of these things help, and again, it is in mining country, so that helps substantially. Cash position of the company is over 70 million Canadian currently, which obviously puts us in a fantastic position to advance this project. No debt, obviously. Just wanted to mention that. But it puts us in a great position to advance this project to a construction decision over the next 2 years and actually have a substantial amount of the equity capital needed for the build. As well, along with that, there'll be in the money warrants that would be coming in next year. So that will help add to the treasury as well. But again, we're in a very strong position for a developer to be able to push this through to a construction decision. Moving forward now, looking at the PEA highlights to give some context, looking at the kind of the major financial metrics. I mean, it's pretty evident the economics were very good. The headline NPV of 1.2 billion after tax, that was at $22 silver, was fantastic. That implies roughly a share price of, a NAV of 462 per share for the project. Fantastic IRR at 38%, a payback of 2 years. If we move into an upside case, which takes the 90th percentile of the 1-year trailing average price, so that implies $27.50 silver, we see that NPV spikes to close to $2 billion, IRR up to 55, and payback just a little over a year. So fantastic economics and leverage for the project. A lot of people talk about tier 1 assets, and we really think you need to have a long mine life, significant production, and low costs. And in our case with Cordero, 16-year mine life was outlined, 26 million ounces silver equivalent, which makes it one of the largest primary silver operations in terms of production at that production level. But in peak years, it's actually quite a bit higher than that. It's well into the 30s. But again, not only is it represent one of the largest primary silver operations, it ranks among the top silver producers totally. In total, even if you compare consolidated production from larger silver miners. We'll look at that in a second. Average life of mine all-in sustaining costs of less than $12.50, another very important metric here for us. Again, that is a combination of a simple flow sheet, simple metallurgy, infrastructure nearby, efficiencies of scale that you get with an open pit mine that you don't get with an underground mine. And most silver mines, a vast majority of them are underground, which have pretty significant sustaining capex. We definitely benefit from this being an open pit mine. Tying that in now, you get that large production, very, very significant production, making it one of the largest silver producers out there, all at a very low capital intensity. So the project is very efficient from a capital point of view. NPV to capex ratio of over 3 times at base case and up to 5x in the upside case. From looking at projects, we all know even a 1-to-1 ratio or 2-to-1 ratio is considered quite good. So Cordero really shows well from a capital efficiency point of view. Another important point, very important, wanted to mention it, is the fact that 99% of the tons in the PEA mine plan are in the measured and indicated category. From other studies, we know typically this is at the PEA level, 20, 30, 40% maybe. So for us to have such a high, again, level of measured and indicated in the mine plan speaks to how de-risked and advanced the project is. And then lastly, looking at silver exposure, you see that for the first 5 years of the mine life, over 60% of the net revenues at Cordero are from silver, and over the life of mine, over 50%. And that compares very well to other senior producers, which typically are in the range of about 30 to 50% typically. And that the company stated there, Coeur, Fresnillo, Hecla, Hochschild, and Pan American. So we compare very favorably in terms of silver exposure. Looking at our peer comparison now, we've got silver equivalent produced. These are 2022 estimates from the BMO silver pages, weekly silver pages. You'll see that Cordero stacks up very well, both year 1 to 10 and life of mine. It stacks up among the top here in terms of Coeur, Hecla, and First Majestic. But what's interesting to note is that that all comes from one mine. You see that bottom row. You see with Coeur, Hecla, First Majestic, that's coming from up to 4 mines in some cases. So again, speaks to the very significant scale of Cordero alone, what a needle mover it is in terms of production, even when comparing against the majors. The other thing to note is these black dots here that are overlaying on top of the bars. Those show the market cap, and you'll see, for example, with like a Hecla or First Majestic, you're talking about a market cap of over $3 billion. If you look at us, we're under about $500 million US. So again, there is a value gap there. Producers were developers, but it's clear kind of path now is outlined for us to be able to de-risk and advance this project further to production and really close off that valuation gap, which is how we hope to execute on our plan here. Moving on to all-in sustaining costs. I talked about it before, but this kind of lays it out versus the peers. Those same silver producers are shown here for 2022 estimates, again, from BMO. Cordero stacks up very well. And again, the open pit helps, the infrastructure helps, the simple metallurgy. Really, all of these things contribute to Cordero having very good all-in sustaining costs, life of mine, and Forbes will be talking about that as well when he moves on to his slides. I will now pass it off to Forbes. Forbes is our VP Corporate Development, and he was the owner's rep on our Cordero technical study. And I'll pass it off to Forbes to lead you through some technical highlights.
Yeah, thanks, Taj. So we'll keep the technical overview at a relatively high level, but feel free if you want to dig into details as part of the Q&A at the end. So we're going to start off with the mine plan. What we're showing here on the right, a plan map that outlines the 4 phases that support the PEA mine plan. They're sort of shown in those shades of sort of pink and purple. But in total, we're mining 228 million tons of mill feed at a very attractive strip ratio of 2.2 to 1. And what's important to note, if you look at that plan map, you'll see that resource pit outline that actually circles the outside the PEA pit. So there's actually more than 300 million tons of resource that sits outside the PEA pit, but still within that resource pit. So if you get silver pushing back into the high 20s and beyond, there's clear visibility here to potentially double the current 16-year mine life. If we now look at the mine plan on a year-by-year basis, year -2, first shovels in the ground, it's a ramp-up year. And what's nice to note after that is if you look at the annual mining rate, it's relatively steady around 65 million tons per annum. And similarly with the strip ratio, relatively steady over the life of the mine. So we feel it's an executable mine plan. And what I'd also point out is these orange columns here. So that's the low-grade material we're sending to the stockpile. And the motivation there is we're trying to prioritize good grades, get them through the mill earlier on the mine life. And by doing so, we send the low-grade stuff to stockpile. You can see this stockpile balance in the background goes to about 60 million tonnes in year 10. And then that stockpile is basically the mill feed the last 4 or 5 years of the mine life. If we now move on to processing, and just for context, we have two main styles of mineralization at Cordero. We have the oxide material, so that's the stuff that sits at surface that is sent to the heap leach and produces doré bars. And then the sulfides is what sort of sits underneath the oxides, and we send that to the mill and we produce concentrates. So the sulfides are the real engine room to the deposit, but we have to mine through the oxides before we get to the sulfides. So year -2, we build out a crushing circuit and the heap leach pad. So that year -1, we're now placing our first tons on the heap leach, the oxide tons, and we're generating some cash flow. And then year 1, we've now put on the sulfide part of the plant. We're now parallel processing sulfides and oxides. By the time we get to year 4, we're out of the best grade oxides, and we're now transitioning to a sulfide only plant, which basically ramps up to sort of 14 million tonne per annum over the life of the mine. And what's really, really positive to point out here is the grade profile. Our best 3 grade years are actually the first 3 years of the mine life. And what that helps is boost the IRR, it helps boost the payback, and ultimately surfaces value when we compile our NPV estimate. And it declines gradually over the life of the mine, and then this is the low-grade stockpile material, which we then feed at the end of the mine life. In terms of the process circuit, very straightforward. This is a very simple process design. We have our main primary crusher. For the oxides, we send them through a secondary and tertiary crusher and then off to the heap leach. Merrill Crowe, we produce doré from the oxides. And then the sulfides, we add another parallel crushing circuit, the secondary and tertiary crusher, and we add a ball mill flotation circuit, and we're producing concentrates. It's a very conventional design. And then when we're out of the oxides and we're converting the plant to sulfides only, what is really nice is that CAPEX, or the infrastructure synergies, we can take advantage of. We already have the crushing in place, so we only have to add a ball mill and a flotation circuit. And what you may also note is there's no SAG mill here. And so when we did our met testing work, we actually got our best recoveries at a very coarse grind size. And so we're targeting a grind size of 200 micron here. And what that means is we can drop the SAG mill and go straight from crushing to ball mill. So that helps from a CAPEX point of view and helps from an OPEX point of view too. So in terms of what that translates to from a production cost profile, look, the first 12 years of the mine life, we're averaging north of 30 million ounces sort of equivalent. And the AISC is actually under $12 per ounce. So very impressive metrics over the first 12 years. The AISC creeps up after that, the production drops off. That's just a function of the low grade nature of the stockpile being fed at the end of the mine life. So Taj has already talked to the site layout infrastructure, and just to put that in context here with the local map of Chihuahua here, this is the Cordero project location. We're just north of Parral. So those familiar with Go Gold, they're processing tailings from the mine of Parral there. The power line that feeds Parral is the Camargo substation. That power line actually crosses our land holding. There's a main highway that runs north-south to Chihuahua, the state capital. And then this is the highway that we would ultimately be trucking the concentrates to Guaymas Port. So excellent setup. And then if you sort of zoom in onto the actual site layout, this is that power line that cuts through our property package. There's an access road there as well. So we've got a huge head start from an infrastructure point of view. and pretty straightforward layout. We've got our open pit stockpile. This is a processing facility, waste dump, and this is a heap leach pad. We're assuming conventional tails for this study, but we'll be doing a trade-off as part of the pre-feasibility study of dry stack versus conventional. And obviously, as we all know, there'll be ESG benefits from dry stack in terms of a smaller footprint and lower water consumption. So we'll take a closer look at that as part of the BFS. So that infrastructure advantage then translates to a CapEx advantage when you look at our initial capital bill. So up front, year -2, we're spending the money on the oxide plant, the heat, and some of the local infrastructure. And then year -1, we're building out the sulfide plant. So it's a total CapEx around 370 million. So a pretty palatable amount given the scale of production we're talking about. Ausenco built these estimates from first principles. So as I'm sure everyone knows, they're very active actually building process plants globally. So they've got very fresh data inputs that went into this estimate, and they also completed a benchmarking exercise as well. So we feel confident in that initial CapEx build. We show the expansion CapEx here, taking advantage of the staged nature of the phasing of the process facility. And our sustaining CapEx around 200 million, about half of that is on the tailings lifts. And keep in mind also, the other half is just general sustaining CapEx, but this is a very simple open pit mine. So a lot of underground operations are quite sustaining CapEx heavy, but not in this case. And so life of mine CapEx sitting around 700 million. So just moving on to OpEx now. So 90% of the operating costs on a dollar basis sit with the mining costs and the sulfide processing costs. So if we focus on the mining costs, those familiar with contract mining in Mexico, often that's sub $2 a ton. So we feel these estimates around $2.16 and $2 a ton are reasonable. And they were actually based on contractor quotes that our mining consultant reached out to in Mexico. So we feel those numbers are defensible. And then in terms of the sulfide processing costs, we're assuming $7 initially and then ramping up to $6.57. Now, the processing costs, we benefit from the fact there's no SAG mill. So that's a huge power cost reduction. And the fact also, power cost in Mexico is relatively cheap at 6 cents per kilowatt hour. So this power cost in some plants is higher than 30%, some even higher than 35%. So this is very power efficient from a cost point of view. Consumables, that's relatively low because there's no SAG mill, and labor relatively low given the cost-effective nature of Mexico labor, certainly significantly more cost-effective than the US and Canada. So ultimately, as a result, the reagents are actually the highest contributor. And these costs were built up, again, from first principles by Ausenco, and were based on our very detailed metallurgical test work program. So again, there's a lot of confidence in these numbers. So finally, some project economics. So our base case, we're sort of highlighting here in gray, 1.2 billion NPV, 38% IRR. But what's really nice is if you stress test the model and take commodity prices down to a silver price of 18 and a zinc price of $1.05, the NPV is still above 700 million, and the IRR is just shy of 30%. So still very healthy metrics. But if you then go the other way and you look to the bottom right, you take zinc to $1.45, and so zinc right now is actually trading above $1.50, and you take silver to 30, which it's pushed quite close to there a couple of times in the last couple of years, but certainly well below its historic high. You see the NPV is now 2 billion, and the IRR is almost 60%. So obviously very, very impressive numbers there. I'll hand it back now to Taj just to wrap up before we jump into any questions.
Perfect. Thanks, Forbes. Moving on to the next slide, we see here the timeline for Cordero, what the plans are for 22 and 23. As you know, we talked about brand new resource estimate was released and a PEA just recently. But the real ultimate goal, a major catalyst for 2022 is the delivery of a pre-feasibility study in Q3 is what we're estimating. So obviously there'll be drilling that goes along with that. We'll also begin construction permitting, and also we haven't talked about as much, but there's going to be also property-wide work. So from a company point of view, we'll be also focusing on that. After the pre-feasibility study, high level, looking at 2023, about a year later, we are aiming for the delivery of our feasibility study, as well as a construction decision on Cordero. What I want to note is based on what numbers you've heard of, you've heard from today, we're trading at probably about a 0.3 times NAV for the Cordero asset. And what you'll see is, and we've shown on the charts previously, looking at peers who start moving into the developer category and then into the production category, that NAV multiple increases substantially. We saw that happen with, for example, other Mexican silver peers, high quality Mexican silver peers, Silvercrest, for example, which is probably now trading at 1.2 times NAV. And then someone who's even further along, another high quality Mexican peer, Mag Silver, who's trading at roughly 2 times NAV. So again, tying this timeline back to value creation, closing the value gap, we think really if we can execute on our plan, we really believe there's a very good way to close that value gap. And then to close off, finally, the presentation, we really believe, the PEA has shown that Cordero has very, very high potential to be a tier 1 silver operation. It has a very rare combination, we believe, in the silver space of size, margin, scalability. Very few assets even have 2 of these characteristics, and we think Cordero has all 3. Size, we've shown you, very, very huge, significant production, putting it among the top of silver peers over a very long mine life. The margin, we talked about the all-in sustaining costs and the very high capital efficiency. Those are, again, both from the PE, the most recently released PEA, and then scalability is something that Forbes spoke to, but the very fact that there's close to 400 million ounces of silver equivalent outside of the PEA pit, that if silver goes into the high 20s and beyond, that now can become part of the mine plan. Doubling the mine life or increasing the production in the other years, it really, really speaks to the natural leverage of our deposit and the fact that it's one of the very few primary silver open pit projects in the world, especially of this size. So that pretty much closes the presentation. I'll send it back to you, Deborah.
Thanks. Actually, one of the questions that we have from the audience, you just half answered, which is you gave the opportunity related to increasing mine production if silver goes north of $30, you said high 20s. But the other part of that question is, what are the costs associated with that?
Yeah, I think I might talk to this image here. So the opportunity, we should flag, we've looked at this through the lens of a junior miner. So if the silver prices move higher and we can build a bigger mill up front, so rather than start at 14 million tonne per annum, maybe we increase that by 50%, which I think a major would certainly look to do. You're going to increase this production level by approximately 50% to begin with. So you're going to certainly compress some of this production, but you're going to see a material boost. And then we start looking at that extra 300 million tonnes of resource that sits outside the PEA pit, because now with that higher throughput, we've brought down our operating costs, especially on the processing G&A side. So we'll be able to add a lot of extra mine life here at the tail end. This AISC should come down because we have those lower operating costs. So there's a lot of opportunity there in terms of the upfront costs for that. We're spending sort of 370 million to get to that sort of throughput of almost 40,000 tonne per day. To get to that higher throughput, maybe we're spending another sort of 150 odd million as a sort of ballpark estimate. But it gives you a feel, if you were a major and looking through a major's lens, you'd go straight to that high throughput, and then now you're producing more than 40 million ounces silver equivalent right out the gate.
The other point I want to note on that is the fact that the resource bit that you saw, that the PEA fits within, the actual strip ratio of that is 1-to-1 roughly. So we again benefit from a very favorable strip ratio. And as you phase into that, the strip ratio is actually extremely attractive. It actually will help bring the costs down, life of mine. But you also have to realize that a lot of deposits can't do what we can do because of the natural geometry of this deposit. This mine sequence that's up on the slide is what you would have done anyway. And you would have pushed back into the next phase anyway. So that kind of optionality that's left is fantastic. Either you accelerate your throughput and get into that phase earlier, if their silver prices are higher, or capex gets paid off earlier, things like that. But it's the natural sequence of phasing you would have done anyway, and you leave that optionality on the table. I wanted to point that out.
Thank you. I think that answers the question. I have a question, which is part of your strategy right now, your drill program strategies, you're chasing some of these high grade veins. How does that potentially affect your production profile down the road? Or is it too early to discuss that?
No, look, I think this is probably a good map to talk to it, right? So it was interesting. We started off drilling out Josephina veins, and there was actually a lot of disseminated mineralization between the two main veins there. So most of Josephina is actually now in the pit. So a main vein target is actually Todos Santos, which sort of sits along this trend here. And then there's also multiple vein trends and underground workings that sit off to the northeast too. So our objective in 2022 is to basically do big step outs on those vein targets I just talked about, and potentially look at including that as part of the PFS if we're seeing the strike, the width, the grade continuity in those key vein trends. And you may have this lovely scenario where you get this beautiful open pit, especially mining here in the early phases, being supplemented by underground mining of this vein material that could be averaging sort of 400, 500, 600 grams per ton silver equivalent. So it could be some nice icing on the cake. The open pit's always going to be the engine room, but this could be a nice sweetener depending on how the drill bit talks to us next year.
Okay. Now I have another audience question, which is, what is the estimated cost to finalize the feasibility study? I'm assuming he means the bankable.
We've looked at some high level modeling of to get to a basically construction decision and see what our balance looks like. If you're sitting in about 70-75 now Canadian, we think basically with the money coming in from in the money warrants and options next year, we'd probably be at a construction decision, say Q2, Q3, 23. So Q3 23 construction decision and have about the same cash balance as we have now, if not probably higher. The thing we are benefiting from pretty substantially is the fact that 99% of our tons in the mine plan are already in the measured and indicated category. It means our infill drilling program is going to be a lot less than originally envisioned. So we're putting all the numbers together over the next few weeks and into budget season of January, but it definitely puts us in a favorable position to have a very reasonable budget to get to a construction decision from especially from where we are.
Are you seeing any inflation? Like, are you seeing costs going up, and how is this impacting your forecasting for how much it's going to cost to get the studies done, as well as to eventually hopefully build the mine?
Yeah, I mean, Ausenco, obviously our main costs are on the sort of process side of things. So Ausenco actively building process plants around the globe right now, so that all these inputs are fresh. But having said that, I think we're seeing inflation across the board. So, we'll do a refresh when we get the PFS, but they priced the sort of equipment and the labor based on Q3, Q4 rates. So this would have already assumed and incorporates some recent inflation. But obviously, if inflation keeps going, absolutely there'll be an increase there. But what is nice also is that we produce silver, we produce lead, we produce zinc. So they should also be beneficiaries of that inflationary environment too. And so there's almost a sort of nice natural hedge there to some degree from the benefit of those high commodity prices.
Makes sense. And I had a question, I guess more macro theme for Mexico. Your assessment of the Mexican government's posturing and actions regarding potential nationalization, downstream, or increased taxation. What do you like? I'm sure it's hard to comment, but do you have any view on what's going on in Mexico?
Yeah, listen, I think there's been a lot of noise since the current administration has come in. I think they have a little over 2 years left. In my opinion, they haven't really done much at all to cause issues other than headline noise. Mining is a pillar of the economy, period. It's one of the most, it's the largest silver producing nation in the world. It's probably among the top 10 in multiple metals. Also, Mexico, mining is completely part of the DNA. I don't think any government that comes in is going to want to mess that up, especially with some of the very large players that are there. And again, we haven't seen much. I will say, I think permitting has slowed down. It used to take maybe 6 months, 8 months to get a permit from the time you had kind of a layout, you submitted your EIA. It probably takes over a year, which is why we're starting earlier. But permits people are getting permits, right? Orla got a permit, Silvercrest got a permit. Mineral Alamos just started a mine at Santana. And there's several others. So, it's for me, it's been headline noise. I don't think anything major is going to come in that will change things, both in terms of nationalization or tax.
Do you think the delay in permitting is like more bureaucracy, more red tape, or does it have to do with labor shortages, perhaps in the government, and just general COVID delays?
That's a very good point. I know for a fact that when the current administration came in, they pretty much completely fired entire permitting groups. And again, maybe it's a message, the optics that they're coming in and changing things, but I think staff levels at various government offices were absolutely decimated, like down to like 20% of what they normally were. COVID exacerbated that. So I think that definitely has something to do with it. On top of the fact that there seems to be a little more red tape than the previous administration. So yeah, I think it's a combination of those two. Again, they've got a little over 2 years left, and obviously in Mexico, federally you can't repeat a term. So things are still getting done, and mining will keep moving on and doing well.
And how are relations with the community you operate in?
Relations are great. There's no one to move. There's no resettlement, etc. So we're actually in a very favorable position that there's infrastructure around us in terms of ways to get in, travel, major highways, power, etc. as we already outlined. But there's no one really around that would need to be resettled, etc. In fact, I'd say if anything, the communities around us want this mine to happen. They know the benefits it can bring. It's one of the great things of operating in Mexico. They get mining, they know the benefits it can bring, and they're extremely supportive of mining in general across Mexico, but our project especially. We've worked very hard on the ESG front, and we've got great community engagement. We'll continue to keep pushing on that front.
Okay, great. I don't see any other audience questions, so if anyone has any, feel free to input them. I have one final question for you, Taj and Forbes, actually. So how did this study line up versus your initial expectations for it?
Yeah, it's a tough question. Look, it's interesting. I mean, we acquired the project from Levon. There was a sort of different focus there. And certainly we've come in and drilled a lot more meters, but I think our higher grade focus and trying to bring good grades forward early in the mine life, and it's actually surfaced a lot of value. I think as a ballpark estimate, not to criticize any of their technical work, because obviously they did an excellent job, but we've effectively halved the mine life, but the NPV is almost double. So I think sort of numerically when we came in, we thought we saw there's a good opportunity to by focusing on the higher grades, improve on that previous work. The fact that we've sort of done it to this extent, I think has been a very pleasant surprise.
Yeah, I'd echo that. I think the high grade zone we always thought was here has gotten quite a bit bigger. You've seen from some of our other previous presentations. We probably think that area is at least tripled, probably 4x in size of what it was originally. I mean, we thought there would be some growth, but it really has shaped up really nicely. So that's just to add to Forbes' comment. But yeah, I completely echo what he had noted.
Well, I think from my perspective, the numbers look really good. This stock's still really cheap compared to peers and your intrinsic value. I know since the time that we've been working together, you've had, I believe, 3 analysts pick up coverage now. Is that correct?
Correct. Yeah.
So starting to really get the name out there. I wouldn't be surprised to see more analysts start to cover the story. And I think you've done a really good job of explaining the most recent studies, just really being clear with the market about what you want to do with the project and in terms of moving it forward. I'm really excited about the drill results that you're going to have over the next little while. I know you've hinted at potentially going after some new targets. Do you want to talk about that at all?
Yeah, we can. I just bring up.
Sorry to put you on the spot, but I thought that'd be a good way to end.
Through the
huge appendix.
So look, this is pretty much where all the drilling that's been done on the property has been in that red circle there. This shows you our land package, and we know there's other big intrusive systems elsewhere on that land package. We're sort of depicting them here in orange, and they are sitting on these major sort of structural belts. Our team down in Mexico have been very active in the field, supplementing that a lot of that earlier work with field mapping, geochemical sampling, etc. So we've now got these targets effectively to a drill ready status. We're hoping to get drilling in those in the first quarter of next year. So look, there's definitely a lot of smoke around. There was a couple of holes poked into these targets previously by Levon with some pretty interesting results. So we're going to try and be a bit more systematic in our approach. We've done some more work in addition to that. This is a 1 billion ton mineralized intrusive system sitting right here. So we're sort of hoping elsewhere within that, there's going to be some other big mineralized intrusions. So time will tell, but yeah, we'll start getting the drill turning on those sort of late Q1 of next year.
I think that'll be good to give the market something else to be excited about. So yeah, thanks. I see actually a couple more audience questions. Let me get to those. Okay. You were releasing drill results monthly throughout the course of this year. Will you have the same cadence going forward?
Yes, we will. We'll probably be maybe every 5 to 6 weeks. We've still got our 4 rigs turning. We'll figure out what the plan is for 2022. But yeah, we still expect every say 5-6 weeks to be putting out drill results in and around the main resource area. And then on top of that, as Forbes had talked about, the property-wide drilling as we start working those up and getting into those for actually the first time. So that should be exciting. Definitely,
the market likes exploration results. And lab turnaround times, have they improved?
We're pretty good actually now. During COVID, definitely, I think they've gone from being like 6 weeks to kind of maybe over 2 months at least. I think I've heard from some of our peers, even sometimes close to 3 months. They seem to be back to normal now. We're turning them in about anywhere from 4 to 6 weeks. So we're hopefully it's a sign that everything's going back to normal. But yeah, no, it's definitely gotten a lot better over the past second half for sure of 2021. All
right. Well, I don't see any other questions. Is there anything that you wanted to cover today that we didn't get to?
There was just one question, Deb, about the how to finance the mine. So yeah, look, I think we're going to be focused on traditional debt and equity, what the split is, 50-50, 40-60. We'll flesh that out as we head down to the sort of PFS and FS deliverables. But we do generate concentrates, so we would look at offtake agreements here too with the key commodity traders. As far as royalties are concerned, look, Eric Sprott, he owns 25% of the company. He's obviously ultra bullish on silver. I think we'd be getting a lot of trouble if we sold a silver stream on this and gave up some of that upside. So I'd say that's lower down the pecking order. And for now, our main focus would really be debt equity and potentially some offtake in there as well.
Okay, great. And just before we wrap up, I know we've covered your catalyst. You had that slide again. You've had a really newsy fall, but it might be good to just touch on the fact that there's still a lot more news to come over 2022 and 2023. So maybe run us through those catalysts and we'll call it a day.
Perfect. Yeah, to wrap up, drill results, like we said, every month to month and a half. Probably once we start getting to the new targets, even more frequently. So it's kind of a two-pronged approach on the kind of the drilling front. One is the near mine, and one is property wide. Again, we really have aspirations for this to become a very large district, and we think there's ripe for some new discoveries in 2022. So that'll keep us busy, and then all of the other incremental catalysts to get to a PFS, more metallurgical testing, submission of permits, and items like that will keep us very active in 2022.
Right. Well, thank you both for taking the time. Congrats on a very positive PEA. Looking forward to seeing some new drill results coming out in the new year. And yeah, if anyone has any questions, feel free to reach out to myself or the company and we'll get those answered for you. And thanks everyone for your time. Have a great afternoon.
Thanks everyone.
Thanks.